Ladies and gentlemen, people of the internet, welcome back to yet another episode of Crypto Over Coffee. I hope you're doing well today, and if you're new here, every Saturday we break down the latest news and the hottest topics in the world of technology and cryptocurrency over a cup of delicious coffee. Now that being said, in today's episode, I'm talking about why Ethereum could be poised for another explosive year in 2022. One of the most useful Ethereum projects that I've been following lately, our usual 404 Logic Not Found segment, and much more. So make sure you stick around for all the updates that we've got in store on this episode. Shout out to the maker of the coffee I've got today in my cup, which is Onyx Coffee Roasters. Now, if you like crypto, please subscribe to the channel, hit the bell notification button, or follow the podcast on your platform of choice so you get a heads up whenever I post new episodes of Crypto Over Coffee. Just a friendly reminder as well, please be aware of scammers that are in the comments on YouTube and all across social media pretending to be me and other crypto YouTubers. I do not have a WhatsApp. I will not ask you to contact me. I'm not going to sell you something. I'm not going to give you an investing strategy. So if the comment does not have the name highlighted on YouTube like you see here, it isn't me. You can go ahead and report them. All right. So please be safe out there, folks. By the way, every week I give away a Keystone tablet steel seed phrase backup by picking a random comment. Literally any comment you make qualifies. So all you have to do to enter this random draw is leave a comment on the video, and you'll be entered to win a steel seed phrase backup. That being said, the winner of last week's giveaway is here on the screen, so congratulations, and I will be in touch. Now, for those of you who clicked this video to learn why 2022 could even be better than 2021 for Ethereum, I've got the show for you. As you know, Ethereum has been one of the best performers this past year and change, crushing several all-time highs price-wise, and of course, has been providing the primary platform on which DeFi and NFTs and all sorts of things have thrived. And you probably also know that Ethereum has been unquestionably broken during these times of growth due to poor scalability, pushing gas prices higher and higher and higher, and pricing out an entire population of crypto enthusiasts and investors who just can't afford to use the network because it costs too much. This demand and interest in Ethereum and its dApps, paired with the large population of people who want to but simply cannot afford to use Ethereum, has set the stage for what I believe will be an even bigger explosion in Ethereum's usage in 2022 and the years to follow. However, to realize this potential, Ethereum's 2.0 merge must be completed, allowing for more scalability at that base layer to provide more supply for transaction throughput to meet the high demand that we see. This merge will see the current proof of work Ethereum network that we use today become one with the proof of stake Ethereum 2.0 beacon chain network that is operating in a sort of shadow mode right now. So it's basically facilitating proof of stake consensus on empty blocks, but there's no real transaction or smart contract functionality there right now. This merge will replace the core consensus mechanism for Ethereum today, but leave intact the core operative parts of the network in smart contracts, for the most part at least. And now there's a significant development that seems to indicate the Great Merge, it is being called, is not so far away. In the Ethereum ecosystem, long-lived testnets are a hotbed for new features and new upgrades to the network. And now there is an Ethereum 2.0 post-merge testnet that will allow developers and regular users to test things out as they will be on mainnet post-merge. And this new testnet is called kintsugi, which is in reference to the Japanese art form of merging or mending broken pottery with gold at the joints. I mean, right off the bat, I respect the nomenclature choice because it's almost a ready admission that Ethereum is broken, but can now be repaired to be better than it has been to date. This kintsugi testnet will let decentralized applications that work today on Ethereum 1.0 test their existing functionality with Ethereum 2.0's beacon chain integration and proof of stake at the core. For the merge, the Ethereum architecture is going to shift a little bit, providing a two-headed client or full node on the network. In other words, each client node on the network that handles transactions, requests, and syncs with the network will have an Ethereum 1.0 client that will serve as the execution engine for smart contracts, and it will also have an Ethereum 2.0 client or beacon consensus node that will serve to manage the consensus process post-merge. This basically keeps this current smart contract execution functionality largely the same as it is today. So everything that works today will work post-merge, but it replaces the underlying consensus layer to the new beacon chain with proof of stake. Why is this significant? because it means that decentralized applications, developer tools, and utilities that interact with Ethereum today will not face this massive rebuild process to work after the merge. And users are not going to require some huge learning curve or migration process to use their usual dApps post-merge as well. Developers will be able to use this Kintsugi testnet to find areas that might need tweaking for both their own apps and tools, but also for Ethereum itself to give their feedback. And this is the first longer-lived public testnet that will execute on this plan for merge and provide realistic testing scenarios for the post-merge specification, which is very significant. After testing and subsequent changes are incorporated, we're just a few testnet runs away from being ready for that great merge, which in my opinion seems to look like a spring or summer 2022 proposition at this point. Many people have begun to discount Ethereum over the last several months because of its scalability issues, but demand and loyalty to the network has not waned as much as you might think. And post-merge, with improved scalability, Ethereum will become more viable for more people to use again. And furthermore, with the addition of progressively more aggressive scalability solutions like sharding and ZK rollups, Ethereum is only going to get easier and cheaper to use for the crypto community and decentralized applications that are built in this space. So the Kintsugi testnet will give developers and users alike the ability to test things out, to provide feedback, to prepare for that great merge, which could very well kick off the next big run for Ethereum, DeFi, and the many applications that rely on the network to provide value to users. So speaking of Ethereum applications as well, I actually want to talk about one application that's building a huge piece of tooling that I expect to play a big part in the future of Ethereum applications, and actually just applications around the space. And that is the Ethereum Push Notification Service, or EPNS. When you use literally any application on your phone or your computer, you have the option of getting notifications that lets you know when something has happened that you might want to attend to. So like when you comment on one of my videos, I get a push notification so I can respond. When my CoinStats app sees that the price of an asset I'm watching moves by more than a couple percent, I get a notification. This is a critical part of most applications and services. However, given the way that blockchains work and that dApps work, there's really not a plethora of great ways to achieve even semi-decentralized and transparent push notification services that are friendly to users. Ethereum offers event subscriptions by subscribing to event topics for things like a new token getting minted or other custom smart contract events. But this is not always the most easy thing for most users to actually take advantage of. EPNS, however, is building a communication protocol, basically, that's designed to provide an adequately decentralized platform on which to distribute push notifications and communications that users can opt into to receive from their favorite dApps and services. Not only that, but it's been architected to support cross-chain communications, so it won't be isolated only to Ethereum apps like I think a lot of people might imagine based on the name. So here's how it works at a very high level. EPNS is effectively facilitated with three main components: the EPNS core smart contract, the EPNS communicator contracts, and the push node network. The EPNS core contract manages the creation of channels and governance therein, which are the logical constructs in which users can opt in to receive notifications and services can push notifications through. That's the channels. The EPNS core lives on the Ethereum network, where the push tokens live, by the way. The EPNS communicator contracts live across many blockchains where apps that wish to communicate notifications end up being deployed. These could be EVM compatible or not. And then finally, the push nodes are basically community-run nodes that aggregate notifications from on and off-chain sources and push them to clients like apps on mobile phones, web apps, browser extensions, desktops, etc. So push nodes are kept honest by economic means via rewards and slashing. So it's the same economic type models that you'd see for something like Chainlink, for example. What EPNS will provide is an extensible communication layer for public use. For example, it will allow you or I to subscribe to liquidation notifications for common DeFi protocols, or get notified when price thresholds are met in aggregation of multiple price feed oracles. The possibilities are pretty endless here, and I'm a big fan of EPNS, and I can't wait for their mainnet launch, which is coming on January 11th. So let me know in the comments how you would use push notifications if you had them in your apps. Now, if we head over to the world of NFTs for a moment, I also want to draw your attention to an interesting project in that area. My friends at NFTy Labs have built a pretty cool utility for event ticket gating, which can be used to authenticate a user to enter a physical event using their native crypto wallet. For example, for an in-person event for specific NFT communities like Cool Cats, users must provide a solution or at least a proof that they own a Cool Cat NFT to get in. So using NFTy Labs or NFTy Labs solutions, event organizers can quickly validate a user's ownership directly on the blockchain and dynamically create a QR code ticket for entry to that event using an application on their phone. So this all happens via common signing mechanics that you'd already be used to with your own wallet on a decentralized application, and it would likely really help reduce friction and the potential for fraud in authenticating entry into an event for a specific community at a conference, for example. Event organizers can also let attendees opt in to share their address for exclusive airdrops or NFT proof of attendance assets. And I really think that applications like this are super valuable to the ecosystem, so I wanted to highlight it here really quickly. So my hat goes off to NFTy Labs. This will be a tool that I'm sure you will find in action at a crypto conference soon enough. Now, folks, it is time for Rational Reactions, which is basically a segment where I take some headlines from various crypto news outlets, and I give you my immediate rational reaction. Well, at least hopefully it's a rational reaction. I suppose that's somewhat subjective. So let's go ahead and get started on rational reactions. Let me pull up the headlines that I've got on the books today. The very first headline that we've got is U.S. lawmaker planning to introduce comprehensive crypto bill in 2022. Cynthia Lummis's proposed bill reportedly aims to provide regulatory clarity on stablecoins, guide regulators around asset classes, and offer consumer protections. All I have to say is thank you. Thank you very much for doing this. Thank you for pushing a bill that actually seems to have some sort of root in reality, that we cannot just destroy an entire area of technology just because we don't understand it. So if we have regulatory clarity, we have the ability to provide space for companies and for DAOs and for organizations and individuals to build cool things without having to pay half of the money they raise to lawyers and accountants and other people to help them stay out of trouble, okay? So great, thank you. Let's hope that this type of stuff gets put into practice, okay? Fighting for Web3. Digital wallet wars are the new browser wars. The same way the browser became the window to the early internet, digital wallets are becoming the interface for the decentralized internet, or Web3. I would agree with this wholeheartedly. The only thing that I want to say is that wallets that are not focused on multi-chain capabilities, the ability to function across multiple different blockchains, are, quite frankly, not going to win out in the end. The first company that comes out with a multi-chain wallet with user-friendly backup and restore functionality that really truly allows you to do all the things on these different blockchains that people love to use, not just store the crypto and just get it stuck there, that's going to be the winner. And I do think that browsers and browser extensions are still going to be very important in the future of the web. Mobile phones can only do so much, at least in terms of their form factor. Okay? Let's see what we got next. We've got another article. Arsenal Football Club in dispute with ASA over irresponsible crypto ad. Following ASA's decision, Arsenal announced that it would appeal against it and stated that it had provided further information regarding financial risks. Now, I'm not a regulator. I never pretend to be. I'm not a lawyer. I don't know necessarily all of the rules and how they are approached around the world, but I've started to see a lot of hate towards soccer clubs or football clubs, which is the proper term, about running cryptocurrency-focused company advertisements. I have a problem with this because ultimately there's so many places where you advertise betting, you advertise gambling when you watch sports. People are advertising horse races or advertising online games or advertising personal credit and things that you can use to buy now, pay later. If those things are allowed, then so should this, because there's risk in crypto, there's risk in all those things as well, especially gambling and taking personal credit for purchases. I don't even really like Arsenal because I'm a Tottenham fan. Hate me if you want. But I don't really think that they should be pinned with this type of thing. Running crypto ads, as long as you say, even in fine text or fine print, there's risk here. I think you've done your due diligence because everyone has to take personal responsibility for the investment decisions that they make, just like they would when they gamble, okay? I don't know what you think about that. Let me know in the comments. Next one is scalability or stability. Solana network outages show work is still needed. Solana's outages could be interpreted as mere hiccups in a new blockchain, but some suggest there's cause for concern. Now listen, I like Solana. I actually do. I was an early proponent of Solana. I talked to the founder early on, one of the founders early on. I do like Solana. Here's the issue. Solana goes down and is completely unresponsive or doesn't work for a period of time. And for a network that is progressively working to decentralize, that's not a good look. Clearly, there are architectural decisions that were made, some challenges that still are going to be faced, where Solana is going to have to come of age, grow up, and solve these problems, because this can't keep happening. You can't keep going down denial of service, whatever it might be. It can't go down. A decentralized network cannot go down. There's a reason why if Bitcoin went down, everyone would be panicking. I'm not saying Solana is dead. I'm not saying it's irreparably broken, but there needs to be some work done here. Crypto donations to charity are booming. What to know before making a year-end gift? But I thought crypto was only for criminals. I thought crypto was only for bad people who want to evade taxes. Seems to me like crypto donations to charity are a pretty good thing, right? I've personally donated a lot of crypto to charity. Yeah, pretty interesting how we have a lot of really nice crypto people who seem to be wanting to donate to charities. Interesting. Good to see that the news is reporting that for once. And lastly, we've got Radio Shack returns as a crypto company. The goal is to, quote, bring cryptocurrency to the mainstream using the well-known consumer brand. This seems like something that Justin Sun would do from Tron. Is to just bring back this brand out of nowhere and just start hyping crypto. Jokes aside, though, honestly, I don't understand this. Because, yeah, I liked Radio Shack when I was a kid, but this is not going to pull me into crypto. Radio Shack really has no relevance. I think this is going to confuse people more than anything else. So, to me, this doesn't make any sense. But let me know, am I being irrational by thinking that Radio Shack rebranding as a crypto company makes absolutely no sense? You tell me. Now, ladies and gentlemen, it is time for 404 Logic Not Found. And for those of you who are as of yet uninitiated in this little firecracker of a segment, I highlight notable tech-related fails or otherwise stupid moves in the world that need to get some attention. And speaking of attention, if you want to help this episode of Crypto Over Coffee get some attention from the algorithm robots, please hit the like button, get subscribed on YouTube, follow the podcast, do whatever you can do to tell those robots that you're enjoying the content, because others might also enjoy it. If you interact with the video, if you interact with the podcast, it might get shared out. So thank you for that in advance. More and more lately, the conversation of regulation and policy related to cryptocurrency, which we've talked about a little bit today, has become this polarized debate of how to protect investors without stifling innovation, or how do we crush this industry altogether in order to protect investors? Underneath both sides of this, there's this theoretical moral compass centered around protecting investors that is used to rationalize the regulatory methodologies that are being proposed. Now, my quandary is not necessarily that regulation is being discussed, because as we know, it's inevitable and in many cases necessary. My main issue is the frankly disingenuous way that it's being pitched under the guise of protecting investors. If you look back throughout history, retail investors, everyday people, are the ones most starved for opportunities, the ones most taken advantage of by sophisticated players, and the ones quite literally robbed by overdraft fees and predatory credit practices in the banking system. Yes, these retail investors bear responsibilities for their own actions. That might lead to these outcomes of losing money. But even in highly regulated areas, I find it hard to argue that these everyday people are adequately protected. The other part of this is that this protection has now devolved into quite literally prohibiting retail investors from taking advantage of opportunities, no matter how well researched they are, nor how well aware they are of the risks. Take cryptocurrency airdrops, for example. Many countries' unclear or overly aggressive regulatory positions have effectively barred their citizens from taking part in what is basically a reward for their loyalty to a protocol, product, or service. That money could have changed these people's lives, but no, they were protected. And you want to get it early on a cryptocurrency. You're not making enough money to be an accredited investor. Well, nope, you're protected from that. You're protected from that opportunity. I fully understand the idea that someone who makes $35,000 a year in a Western country should probably not be risking $5,000 on a highly speculative early investment in a company or an early cryptocurrency round. But if that person understands the risks, if they're highly educated on this topic, I'm not sure the answer is to outright ban them from doing so. And what bothers me about this the most is that it's basically drawing a line based on income or net worth that says whether a person is competent enough or sophisticated enough to have the right to these opportunities. And that really rubs me the wrong way because there's so many brilliant people out there. There has to be a more egalitarian balance here that allows people to have good opportunities to invest early and get good prices on equities and cryptocurrencies and other assets that they have conviction in without being pushed into insane risk that they can't tolerate. Those who are bereft of these opportunities, in my opinion, are being failed by the regulatory environment and not even close to protected. You're going to stop families from losing their shirt on a speculative investment that goes off the rails. Yeah, you'll do that occasionally, but you're also preventing many others from potentially changing their lives with the investments that work out. At the same time, anyone over the age of 18 in the US, for example, can open a Robinhood account and trade options and have no idea what they're doing. So that incongruence is not pointed out to say that we should ban options, but we should be focused on education and giving investors and everyday people who wish to invest the tools they need to make good decisions, to invest in a responsible way, to protect themselves rather than just taking away the opportunity for them to make a mistake altogether. All this suffices to say that I hold the opinion that any regulation that is posed for cryptocurrencies and even for securities going forward should not be made with the promise of investor protection unless there are actual provisions to protect investors without stripping them of their ability to invest in things. That's not only disingenuous, but it's also a clear 404 logic not found. Taking away an opportunity is not protecting. If you provide education, real education, and you provide just guardrails for people so they don't go off the edge, you can protect them without taking away all their opportunities. I would love to have the chance to be involved in these discussions with lawmakers around the world about how to achieve this. Maybe one day that will happen, but for now, I'm really happy that I get to speak to you about it. All right, folks, it is sponsor time, which keeps the coffee flowing and this show coming to you every weekend on all platforms. First, I want to shout out the long-term sponsor of Crypto Over Coffee, Ledn, who are my go-to spot for BTC and USDC yield earning in their savings account product. You will not find a bank paying out 9.5% APY on USD, my friends, nowhere. USDC on Ledn, however, does get that. I also want to congratulate Ledn on their recent $70 million Series B funding round, which will help them build upon their already fantastic product offering that you really need to try if you haven't already. One such new offering is their recently announced Bitcoin-backed mortgage product, which lets Bitcoin holders get mortgage lending with their Bitcoin as collateral for the loan. The goal is to give more people the ability to qualify to buy property without explicitly requiring them to divest or sell their Bitcoin holdings. This focus on providing opportunities for more people around the world to own property, to make money, to be in a better financial place is why I am proud to support Ledn as both a customer of theirs and an evangelist for their platform. So please do check out Ledn using my link in the description and the pinned comment down below if you would like to learn more. I would also like to share some information about my friends at Unstoppable Domains who provide blockchain-based domains with extensions like .nft, .crypto, etc. With these domains, you can provide your friends a human-readable name that maps to many cryptocurrency addresses to send and receive crypto transactions and even build your own decentralized website that is routed using your domain. For example, I have my own website at hashoshi.crypto where all the content is stored on IPFS. If you want to learn more about all the things you can do with your own domain from Unstoppable Domains, check out my referral link in the description below to find out more. All right, as we always do, let's do some community Q&A. I always answer questions from folks who watch the show, and I've got some questions from last week's episode that I'm going to answer here. And I want to remind you that if you have a question, and any question goes, there's no such thing as a stupid question, leave them in the comments below on YouTube, or you can tweet me at Hashoshi4 if you're on the podcast platforms where comments are not available. So let's go ahead and dive into these questions and see what we've got. Okay, let's see. We've got a few questions here from the YouTube comments. First one of those is from Matthew Santana. I've been listening for a couple months now, and I'm curious where most people get their crypto news. I'm still pretty new to this. Technically, I've held Bitcoin for a few years, but just starting to actually learn. Okay, so Matthew, here's a couple things. Usually people get their crypto news from YouTubers. I think there's no secret there. Most people go and they look for crypto news from YouTubers. What I want to warn people about is that my channel is no different. I try and be as balanced as I can, but every human being has implicit biases and their own opinions about things, right? So when someone comes here maybe looking for a contrarian opinion to cryptocurrency, like, do NFTs suck, right? I'm probably not going to be the person who's going to look at it and say, yeah, NFTs are bad, right? Because I'm a fan and advocate of NFTs generally as a technology. So with that knowledge, knowing that everyone has these implicit biases, you need to either watch multiple YouTubers that have different opinions so that you can balance the perspective that you're getting, or you need to start augmenting that with your own research protocols. And crypto news you can get from a variety of sources. You just need to have some healthy skepticism and look very clearly to make sure things are represented in a way that's consistent across multiple publications. So if you read something on Cointelegraph, see if there's an article posted about it on CoinDesk or on some of the blogs at Gemini, for example. Some of these other exchanges will post some pieces as well. If you can start to see a pattern, you can get a well-rounded view from multiple different sources. So I always try and read the same topic or the same story at multiple publications to make sure that I'm getting a well-rounded viewpoint. And if I see consistency across everything, I'm starting to be more confident that what I'm reading is true and is factually represented. So that's one way that I do it. CoinDesk, Cointelegraph, there's actually some good stuff in various publications about products on, occasionally, very occasionally on mainstream media pages. But I would be very focused on YouTube, well-rounded, search across multiple creators, and on publications, read across multiple publications and make sure you get in the full story. Okay? Thank you very much. Next question is from Michael Amos. Everybody says do your own research, or DYOR. How would you succinctly encapsulate that process? If I do X, Y, and Z, then I can feel like I did that. This is kind of a continuation of the last question. I think that's probably why I grabbed this one as well. So Michael, this is what I would say. In terms of do your own research, everyone is different. Everyone is going to feel more or less comfortable depending on what they know and how they research. Some people are very focused on the technical. Some people are very focused on the fundamental. Some people are focused on both. Other people want to do TA. I leave that part up to you. What are you the most comfortable with? But what I will say is that do your own research really means that you need to look at what your goals are when you're trying to make a decision. Some people are saying do your own research to invest, but have no idea what that means. If you're going to invest in something, doing your own research means making a plan for that investment. What is my profit target? What is my contingency plan if this goes down? Can I hold on to this and ride this out till next year? If I buy it and it goes down, do I just sell out of it because I don't believe in it long term and I'm going to take that loss? Those are things you need to do. So making a plan around your investment. The other thing is before you invest, you need to determine if it's worthy of an investment. And you can only make that plan when you've done this research. So that would be looking at the white paper. That would be looking at the light paper. That would be looking deeply into the documentation on that particular project's site, looking at their GitHub activity, not just looking at commits, but maybe getting a friend or yourself, if you understand programming, looking and seeing what that team is working on in their open source repositories. That also might be looking outward at different YouTubers and trying to see their perspective, going on social media and seeing what the buzz is all about, looking at the community, getting in that Telegram channel, talking to people, understanding the project and the goals and what's coming next from the people who really get it. Okay, those would be some of the things that I do when I'm doing research on a project that I need to figure out. And the other thing is too, I look at it from the perspective of how does this fit into the rest of my portfolio and the things that I've done in the past, the anecdotal evidence that I have. Always pretty interesting to see. So those are some of the things. Last thing I'll mention is tools like Santiment and Trade the Chain are great sentiment analysis and on-chain metrics tools that I use all the time to make a determination to help me formulate that plan. So there's that as well. Thank you for your question. Last question of the day is from Dylan Pape. I get frustrated at the likes of Michael Saylor giving his grandiose facade of intellectual legitimacy to the HODL meme or HODL meme. Why would you ever sell the apex human property that has ever existed? Like, I don't know, maybe to buy back more cheaper later. Now, this is a great one because I've railed against the whole idea of investing strategies being used or being developed using memes, which is basically like I'm never selling or hodl, these sorts of things that are just like things we say but aren't really supposed to be strategies. Like people hold altcoins to zero all the time. People like Michael Saylor are heavily invested in Bitcoin. So think about why that person, I think they have like 122,000 Bitcoin at MicroStrategy. Michael Saylor is the one who's been doing, or at least steering the ship in that direction. Why do you think he would say only hold, don't sell? Because if you sell and a bunch of other people sell, then the Bitcoin that he has is worth less. The Bitcoin that MicroStrategy has is worth less, theoretically. Okay, I'm simplifying, but theoretically. So the idea is clearly he has this conviction because he's bought 122,000 Bitcoin at MicroStrategy, maybe even more at the time of recording here. Ultimately, though, what I want everyone to realize is that these types of things are implicitly biased. And that's why I say in the do your own research section and in the question about how you go about finding news, take these things with a grain of salt because everyone has a reason for what they're saying, okay? Everyone has a predisposition to a certain opinion based on their own life, maybe their own financial position, maybe their own holdings, maybe they just had a bad experience with a cryptocurrency or with a project and they're projecting that in their opinion and in their media. And so, yes, Dylan, I completely agree. You can sell Bitcoin. You can still sell Bitcoin and believe in it long term if you're just trying to re-enter at a better price, okay? You can sell for a loss to capitalize on a tax loss harvesting move, buy right back in shortly thereafter, okay? These are all things that you can do as long as it's part of a plan. Don't let other people dissuade you, I guess is my main point. Don't let other people dissuade you. Stick to your plan, stick to your goals, and you will be okay. All right? Thank you so much for watching this episode and every other episode of Crypto Over Coffee. I want to wish everyone who celebrates Christmas a Merry Christmas. I know it's the day after. I didn't want to post this on the day so you guys all had time to be with your families. Otherwise, happy holidays to everyone else. Thank you so much for watching. Seriously, if you have time to stick around, more crypto videos here on the screen. And of course, hope you and your family has a wonderful week and weekend ahead. Until next time, cheers.